5 risk signals executives should act on before Q2. Q1 did not deliver a single defining shock. It delivered something more consequential: alignment. Across energy markets, regulatory posture, infrastructure constraints, and capital flows, multiple signals are beginning to reinforce each other. Individually, each might look manageable. Together, they reshape the risk landscape for Q2. For executive leadership and finance teams, the question is no longer what happened in Q1. It is what these converging signals force you to reconsider before mid-year capital decisions harden. Below are 5 signals that merit direct board-level attention. 1. Energy is repricing as a structural input, not a variable cost. Energy volatility is no longer episodic. In multiple regional markets, long-term power pricing assumptions are being revised upward as data center demand accelerates faster than interconnection capacity. Grid congestion persists in constrained transmission corridors. Reserve margins tighten in high-growth load regions. The shift is subtle but material. Energy is moving from an operating expense sensitivity to a structural capital planning constraint. For finance leaders, this affects IRR modeling on new facilities, long-term lease decisions, siting strategy for expansions, power purchase agreement PPA duration and structure. If Q1 revealed anything, it is that load growth forecasts and infrastructure build-out timelines are no longer synchronized. That gap carries financial consequences. 2. Regulatory exposure is expanding upstream. The perimeter of national security and regulatory authority continues widening into foundational industrial inputs. Recent federal actions tying critical materials and agricultural inputs to defense priorities signal a broader pattern. Upstream supply chain nodes are being reclassified as strategic infrastructure. For executives, this introduces 3 risks: sudden production prioritization under federal authority, reallocation of materials across sectors, contractual disruption in concentrated supply chains. This is not limited to defense-linked sectors. It affects chemicals, minerals, semiconductors, and specialty industrial components. Procurement and finance teams should be reassessing concentration risk in light of regulatory optionality, not just market forces. 3. Capital is flowing selectively, not broadly. While aggregate clean energy investment remains strong, Q1 revealed sharper segmentation. Capital is concentrating around assets with predictable regulatory environments, regions with transmission clarity, projects with secured offtake or contracted revenue streams. Meanwhile, projects facing permitting uncertainty, interconnection delays, or subsidy ambiguity are seeing extended financing timelines. The implication? Capital is not retreating, but it is discriminating. For executive teams, this matters in 2 ways: cost of capital divergence between clear and uncertain jurisdictions, increased scrutiny from lenders on grid exposure and compliance durability. Projects that were financeable in 2023 under generalized sustainability momentum now require more granular risk proof. 4. Infrastructure constraints are becoming strategy constraints. Infrastructure readiness, transmission, water access, transportation corridors, is emerging as a gating variable for decarbonization and growth strategies. Across sectors, industrial electrification plans are colliding with substation and transformer lead times. On-site generation proposals are slowed by interconnection studies. Water-intensive operations face regional stress disclosures. These are not operational inconveniences. They are timeline risks. For leadership teams heading into Q2 budget adjustments, this reframes a critical question. Is your decarbonization strategy aligned with infrastructure reality or dependent on assumed upgrades? The difference determines whether 2026-2028 capital programs remain credible. 5. Risk is being repriced, quietly. Insurance markets, lenders, and rating agencies are incrementally adjusting how they model physical climate exposure, energy price volatility, regulatory uncertainty, supply chain concentration. The repricing is not dramatic, but it is directional. When multiple risk factors trend in the same direction, marginal cost increases compound. Higher insurance premiums, tighter loan covenants, increased disclosure scrutiny, more conservative underwriting assumptions. Q2 earnings calls will begin reflecting this through cautious language on forward guidance and capital discipline. Executives who treat these shifts as background noise risk discovering that capital access has narrowed after decisions are already locked in. What this changes before mid-year. These signals converge around one core reality: the margin for strategic flexibility is narrowing. Heading into Q2, executive leadership teams should be explicitly asking, where are our capital plans exposed to infrastructure timing assumptions? Which suppliers operate in sectors vulnerable to federal prioritization authority? Are our energy cost forecasts stress tested against constrained regional grids? How sensitive is our cost of capital to regulatory clarity in key jurisdictions? The organizations that adapt early will not necessarily spend more, but they will allocate differently. Capital discipline in 2026 is less about restraint and more about precision. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.